Hi, I'm Kim-Mai Cutler, and we're here in the studio today with Scott Raney, who is a partner at Redpoint Ventures. And this is an especially notable week because you guys scored Path. And so I was hoping maybe you could tell us a little bit about why you went on in them, and maybe a little bit about how you got that deal.
Great. Well, thanks for having me. We have known Dave and the team for quite some time now. We'd actually worked with Dave on a board level at another investment we made in a company called Simple Geo, and through that built a very good relationship with Dave, and we think the world of him, and got a chance to get to know the rest of the team, and our impression is these are guys that we want to be in business with. And so we had been having conversations with Dave and the team for some time, even prior to
months.
Even prior to the last round of investment, and I've been keeping a very close eye on. When they launched the new product late last year, we were really blown away by the product and the potential, and so we decided that it was something that we absolutely wanted to be a part of, and we were lucky enough that Dave and team decided that we'd make a good partner. I think for us, we really view it as something that has the potential to be very significant. We think that mobile is really going to transform the way that people think about social and social experiences. And I think as we look at the landscape, there are only a couple of companies in mobile that I think are really thinking about disruptive social experiences, and Path is certainly one of them. And so
how much competition was there for this particular deal?
Yeah, it felt very competitive from our end. Don't have.
You don't have like a story,
maybe?
What did you do? I mean, do you have a trick that you used to win him over?
No, well, hopefully we're not using tricks to win these deals. Hopefully we're winning it through our own merit. But I think, as we said, we've known Dave for a while, so this wasn't like us just giving him a call and saying we'd like to invest. This has been a relationship that we've been forging for some time. So, and it is it certainly was a company that a lot of people are very interested in investing in.
So. From what I understand, you guys signed the term sheets a while ago, but just totally hypothetically speaking, if the Instagram, $1 billion acquisition by Facebook had happened before, the deal was effectively closed, I mean, do you have any thoughts on how it might have come out differently?
Yeah, I can't speculate. I really don't know. All I can speak to is that I think that certainly people's expectations about the value of their companies has probably changed over the last week to two after the Instagram deal. It was obviously a fantastic outcome for Kevin and team, and I think one that really, again, represents the potential for these mobile social experiences. I'm sure that there will be entrepreneurs.
Do you have any thoughts? Would the valuation have come out higher or lower than what it was?
I don't think it would have. I certainly don't think it would have been lower. But it may have influenced. I actually think in the end. The reality is every situation is different, right? And so it's really hard to say that one particular event is, necessarily requires you to kind of rethink the value of every company in a space. But, I think that anytime you see a big outcome like that, obviously people's expectations are reset.
And I think we talked a little bit about this, before we started filming. But the reason that Facebook bought Instagram was in part because it was just growing so fast that at some level it might have posed kind of an existential threat to Facebook in an area that they're very strategically weak in.
Sure.
And so they effectively paid for users, and at the time Instagram had somewhere between 30 and 40 million users. So if you take on a per user basis, it probably came out to slightly over $30. And at the reported valuation that you guys invested in Path, that was a lot higher. It was a lot richer valuation on a per user basis. So why, maybe you want to talk about a little bit of the justification.
So as I said, I can't speak about the valuation. I'm not, it hasn't been announced and we haven't disclosed it. So in terms of the specifics, there's not much I can say there other than that. I think at different times in evolution of companies, you probably are paying a premium relative to kind of where things ultimately end up for some of these companies, and it's part of just wanting to get into great companies and ones that you think have the potential to be really, really big and fundamental and important. And certainly we viewed Path in that light. And so, I think that we feel very comfortable as investors that we're going to see a very good return from that investment, regardless of maybe what the per user metrics look like today. It's a very fast-growing company and one that we think holds a lot of both. A lot of potential value, particularly strategically. So.
And I'm also wondering, something that Dave talks about a lot is about growing a company in a very kind of slow thoughtful way. But when you look at the market now and you look at consumer web and mobile properties, the deals that everyone the deals that everyone is fighting over are the sort of Pinterest or the OMG Pops Draw Something. There are these companies that are really taking advantage of these astronomically low costs of distribution and user acquisition, whereas Path is kind of taking a very different approach. It in some ways is making it, its cost of distribution a little bit higher by limiting friend networks. What do you think of that?
Yeah, that's. I guess I wouldn't agree with the conclusion you're drawing. I actually think that there's plenty of paths to Path to grow, to acquire customers relatively inexpensively, and they certainly are taking advantage of it. One is that it's just a phenomenal product, and people love it, and word of mouth is amazing. And but there are a lot of viral hooks that kind of be laid into that product that I think will have the potential to drive really fantastic user economics over time. But Path is going to grow, and I have no doubt that they're going to grow, and they're going to grow in a very kind of efficient and economic way. So we're really excited about it.
And then with the new benchmark, I guess, that some of these deals have set in the last couple of weeks for what a mobile app company can be worth. I mean, how are you as an investor going to be very thoughtful and disciplined about, not being taken away with all of the momentum that we've seen?
It is super hard as a venture capitalist now not to get swept away. I mean, there are so many interesting and disruptive businesses that are being built that, and obviously some fantastic outcomes that could certainly lead you to justify very high valuations for investments these days. And for us, it's just a matter of making sure that we're investing in companies that we think have the chance to be really big and really disruptive, and just trying to stay disciplined on that. And there are times in the venture industry where you pay more for good companies, and times when you pay less. And our attitude is, let's just try to be in the best companies and not worry too much about responding to the specific dynamics within the valuation environment. So it'd be a mistake for any venture firm to invest in a bunch of deals in a short period of time at very high valuations. Time diversity in funds is really, really important, and you've got to. What you want to do is kind of build in over the life of a fund, the understanding or expectation that valuation environments are going to change, right? And
so I was going to ask, how is the competition, between you and other firms and other, kind of newer players in the landscape, like Super Angels, and then newer international funds like DST? How is that changing the competition for you guys?
Yeah, there are probably different dynamics at every stage in terms of kind of what's happening at the seed stage, what's happening in Series C, and what's happening at later stages. But what I would say now is, it is a very competitive environment. There are a handful of firms that are being really active and are very good firms that can add a lot of value to these companies, and so we're competing against those guys for those deals. The seed stage, I think it's pretty clear that there's a role for venture guys to play in seed deals. And there was a question, I think, a couple years ago is whether or not venture guys should be investing in seed companies, or whether or not companies should take venture money. And I think over the last couple of years, it's been demonstrated that there's a lot of reasons why you'd like to have a handful of venture guys. And so we're seeing that at least their entrepreneurs are very open-minded to having venture involved in the situations we feel like we can compete effectively in the areas in which we invest. In Series A, the valuations have certainly gone up, and I think a lot of that is driven by this kind of competitor response. And one of the things is you got a lot of great people in the venture industry, and you're trying to get in a great deal. One of the best ways to differentiate yourself is your willingness to pay potentially a higher price, right? And so we're seeing that reflected in the prices. And then what I'd say on the growth stage, what's really interesting there is that basically every company is raising money right now. Even if you don't need the money, you'll raise money if somebody came to you with attractive terms, because there are usually investors that are willing enough to actually put forth terms that would at least turn your head and make you consider, right? So the key there in competing is that you've got to be building relationships with these companies over time, and you've got to you can't just expect that at some point they're going to raise their hand and say, okay, we're raising a Series C now. We'd like to talk to you. You've got to be there long before then, building a relationship and potentially catalyzing deals. And that is, again, a function of the fact that I think there are a handful of firms that want to be in great deals, and they're going to find them whatever stage they're at right now.
Do you have any kind of war stories or anecdotes of things that you've heard or that you guys are doing really to court entrepreneurs?
I don't think I have anything particularly interesting. I mean, I would describe you a story about how we've seen dynamics where firms have asked entrepreneurs to change plans and then have compensated them for those changes. But I think that there clearly is. Everyone is being really, really aggressive right now, and you can basically assume in any situation, if you think maybe you have an inside track at a deal or you have a better relationship than other venture guys, that there is another guy that's right behind you that's courting those entrepreneurs as well. So it's it's the nature of the game.
Tough life out there.
It's tough. It's actually it is tough. But I would tell you that the reason that it makes the deal dynamics are tough is because there's so many amazing companies that are getting started right now. So it is a lot of fun because we're dealing with companies that really are doing some very disruptive things that we think can be really, really big. And I've been in the venture industry for a bit now, and this is by far the most exciting time that I've been in terms of just the overall caliber of company and just the quantity of interesting companies. And so, it's really enjoyable, even with the dynamics at play in terms of getting into these deals. It's really enjoyable to be meeting with companies that you think really can make a difference, and so we're really excited.
Cool. Well, I think that's all the time we have, so I want to thank you for stopping by. Thanks.
Thank you.